All right, good day, everybody, and welcome to the VectorVest International Online Forum for Saturday, October 7th, 2023. We are moving along. I don't know, this is a rapid clip. Um, Thank you, everybody, for making us part of your day and part of your weekend. And hopefully everybody's staying safe and healthy wherever they are. And a special shout out to all the Canadian viewers out there. We do have, this is a long weekend in Canada. It's Thanksgiving. So happy Thanksgiving. I hope everybody is able to share some good times, some good meals, some drink possibly with family and friends. So hello to everybody out there. It looks like we're good. I know I've seen Jay in the chat. Marty, good morning, everybody. Luke, Mary, we've got people from all over. It looks like Mary from Iowa. So good day, everybody. And we've got quite the lineup for you today. We've got, very challenging times and interesting times in all of our markets. So I think you're going to really enjoy the content today. So let's get things started. As usual, we'll start with the risk disclaimer. As everybody knows, there is risk in investing. Everything you will see and hear today is provided for educational purposes only and should never be considered as investment advice. The information is designed to empower you to make your own investment decisions, and these decisions are yours and yours alone to make. Our agenda for today, we've got the welcome happening right now. We will do a global market forecast. And now if Joey can bring everybody in, I'd like to introduce everybody to our esteemed colleagues that we have here today. We have Mr. Steve Chappell, Director of Trading Systems Development. Everybody knows Steve from the Jockey Club, the Swing Trading Coaching Group. He's been with VectorVest for many, many years. And what's probably one of the best things we can say about Steve is he is a steady hand on the tiller, always giving very good guidance, timely guidance, an expert at using the VectorVest system. And we're also so happy to be joined by Susan HayesCulleton, esteemed author, speaker, and Steve, I think you would agree she is our most favorite Irish economist of all time. All time.
Yes, I love
There
my
is no
Susan
other.
in many, many ways.
All right, so Steve will be giving, I'll be covering the VectorVest markets around the world. Steve will be doing an in-depth market analysis, and Susan will be doing how to read earnings report. That's something that everybody has been asking for. So she will be covering that today. We'll be adjourning around 12:30. The replay, so this is on YouTube, so the recording will be available after the webinar, right at the same location on the VectorVest YouTube channel. And the slides will be sent out in an email Monday afternoon. Okay, so with all of that said, let's start making our way through our presentations, and I'll start off with the global market review. All right, so we'll start off with the Canada and the US. First of all, here to the right on this slide, you'll see September was not kind across the VectorVest Nation, or VV Nation, as Glenn likes to refer to it. You can see if we do a quick review here, Canada was down 3.23%, the US off 4.83%, Australia off 3.73%, the EU off 3.03%, the UK fared the best, off just 0.86%. Okay, so that was for September. Year to date, we're all in still in the black. Canada with a 2.74% gain, the US with a 2.86% gain, Australia up 1.97%, the EU leading the way, 4.03% gain, and the UK with a 3.08% gain. So let's take a run through the color guards of the various nations, if we can. So we'll start with Canada. You can see that our market time engaged needle straight up into the yellow. The color guard is neutral. VectorVest does not advocate buying any stocks at this time. Okay, and you can see in the Canadian market, on the 6th, we've had 3 yellow lights, of course. The BSR and the MTI did reach bottoming levels in Canada. The BSR is at an extremely oversold level right now of 0.08. The MTI got down to 0.60, stayed there for 3 days. We got a bit of a lift on Friday. We are in a down situation. We're in a confirmed down as well. And as you can see below, we've been in a confirmed down since the 16th of August. The DEW has been down since the 19th of September. Our green light buyer indicator has been neutral since the 15th of September. And the primary wave has been down since the 19th of September. All right, and we're going to see a lot of similarities as we take a look and jump from one country to the other. So moving to the US next, you'll see also market time engaged needle straight up into the yellow. Color guard is neutral. VectorVest does not advocate buying any stocks at this time. We've got our 3 yellows at the top of the color guard. Much like in Canada, you can see a lot of red in the extended version of the color guard, more yellow on the US side than red. However, on the US side, the BSR and the MTI did get into the bottoming levels as well. The MTI did drop below the 0.60 level, unlike Canada. But we have seen a bit of an increase over the last few days. Now, everybody's going to be looking for that elusive blast off. We have seen our markets move up, but we have not seen our key indicators show that these markets are starting to go with any kind of fervor at all. All right, so I want to make sure we get that pointed out. You always want to keep your eye on the indicators. So in the US, we are in a down situation. We're in a confirmed down. That confirmed down has been since the 9th of August. The DEW has been down since the 11th of August. Green light buyer has been neutral since the 15th of September. And the primary wave has been down since the 15th of September. All right, so that's Canada and the US. Let's move on now to Australia. We're going to head down under. So there you can see Australia with their year-to-date gain of 1.97. Also, you'll see we've got a common theme here. Market time engaged needle straight up into the yellow. Color guard is neutral. VectorVest does not advocate buying any stocks at this time. A repeat of what we saw in Canada and the US. We do have a BSR down at extreme oversold levels. The MTI didn't quite get to bottoming levels. It got fairly low. It's sitting at 0.68 for the last 3 days. They are in a down situation. They have a confirmed down. Their confirmed down has been since the 13th of September. Their DEW has been down since the 18th of September. Green light buyer has been in neutral since the 14th of September, and the primary wave has been down since the 19th of September in Australia. Moving next to the EU, you see them with their year-to-date 4.03 leading gain. Market time engaged needle straight up into the yellow. Color guard is neutral. VectorVest again does not advocate buying any stocks. We've got our 3 yellow lights in the top row of the color guard. BSR down below the 0.20 level, so in bottoming levels, was down to 0.11 at 3 days ago, it looks like. MTI down to 0.77, so not quite down to bottoming levels in the MTI. We're in a down trend. The confirmed down has been that way since the 11th of August. The DEW has been down since the 9th of August, and the green light buyer has been neutral since the 18th of September. Their primary wave has been down since the 21st of September. All right, and lastly here, we're going to move to the UK. You can see them with their positive 3.08% year-to-date gain, and a mirror image of all the rest of our nations. Our market timing gauge needle straight up into the yellow. VectorVest, or the color guard, is neutral, and VectorVest does not advocate buying any stocks at this time. Same story in the color guard. We see a lot of red on the UK side. It looks like the BSR did get to the 0.20 and below bottoming level, so oversold levels. It also is on the rise as of late. The MTI didn't get down to 0.60, it got down to about 0.74. And you can see a little bit of rise, 0.01, just over the last day. They are also in the down condition, and the confirmed down as well. They're confirmed down since the 2nd of October. Their DEW has been down since the 27th of September. They've been in a neutral position from a green light buyer perspective since the 3rd of October. And their primary wave has been down since the 21st of September. All right, so that's a run through the color guards of all of the VectorVest nations. The next thing we're going to take a look at is the performance of the global markets, global market tracking ETFs, and these are in the U.S. market. We're looking to see if we can get some kind of indication of, which nations are moving. So you can see 2023 year to date, the NASDAQ still leading the way with just shy of a 37% gain. Greece coming in second, Taiwan, the S&P 500 with a SPY in fourth, and then followed by Spain and Italy. All right, and year to date in 2023, you can see out of all of the global ETFs, we've had 27 winners, 16 losers. All right, if we look at these ETFs just over September, you can see just how brutal September was. If we take a look here, look what we have. We have 3 winners, 40 losers. You can see Turkey out in front, the Philippines, India, Brazil, and the UK. But if you take a look, only the top 3 are in positive territory in the month of September. Okay, Turkey leading the way with a 2.91% gain. All right, and if we look at the next slide, we'll see a monthly comparison of these global ETFs. So we can see, if we look at August, Turkey was able to maintain its top position here. However, you can see that the NASDAQ, China, Japan, and Australia have dropped out of the top and have been replaced by the Philippines, India, Brazil, and the UK. All right, so that's a quick run through our global market tracking ETFs. And as I mentioned, these can be found in the US market in the cherry picking folder. All right, so the next thing we will move into is in the same folder. We're looking at the performance of the market sector ETFs. So obviously here we're looking in the US market. So you can see year to date. Here are the symbols leading the way. So we've got SMH semis, we've got XLC, XLK, which is S&P Tech, ITB, which is U.S. home construction, XLY, S&P 500 consumer discretionary, and XHB home builders, leading the way year to date. If we look at that same group and look to see who's been moving over the last 10 days, here you can see the movers, the top gainers in a 10-day time period. So we do have SMH still at the top. You've got an Invesco Next Gen ETF GGME, XLK that we did see over here, XLC we also saw over in the 2023 year to date. And then we've got a spotter S&P software. All right. And again, in that list, you can see there's only a handful that in a 10-day time period have positive gains. It looks like there's only 5 of them. All right. So the next thing we will move on to here is our essays from around the VectorVest world. This is for October 6, 2023. And as usual, folks, we have an excellent assortment of essays here. So much good work is being done by everybody writing these essays. Very timely information can be found here. I hope everybody is able to log into each of these countries and check out the essays in all of them. So on the US side, we've got an excellent essay from Angela Akers. It's called The Reckoning Continues, and she has a very important discussion about how important earnings yield and investment yield are, and really tells us how no investor should ignore these things. She literally, in that essay talks about, of course, the late great Dr. D, how he imparted his knowledge and ensured she understood how important these 2 indicators are. So if you can, check out that essay. You do not want to miss it. We've also got an excellent essay from on the Canadian side from Stan Heller, the Ticker Tester Portfolio Challenge Leaderboard. I hope everybody knows there is a competition being run in the Canadian version of VectorVest. Anybody can join that competition. It's running for the month of October. And Stan is doing a review of the competition here and keeping everybody updated in his essay. So everybody, if you can, check that one out. Out of the UK, VectorVest continues to honor, of course, our late great friend, mentor, Dr. David Paul, with a series of his essays. And I'm telling you, this one is one of my absolute favorites, How to Sidestep the 4 Major Trading Fears. Do not miss that essay. Moving to the EU, I don't know who it is in the EU who writes these essays, somebody by the name of Susan HayesCulleton. And she's continuing her essay series in memory of course, the late, great Dr. D. This one entitled, Look How She Can Predict the Graph. And this comes from the time where she was able to travel on the road with Dr. D and Steve, as well as other VectorVest members and money shows and those types of events. So another excellent essay there. And then the last one to round things out of Robert and Russell Markham in Australia, theirs was entitled Uranium Spot Prices Are Surging. So they're pointing out how you can use VectorVest to analyze stocks and pick movers that are benefiting from the surge in uranium prices that's happening. All right, so that's the essays from around the VectorVest world. And it looks like at this point, I'm going to be able to hand over the reins to Mr. Steve Chappell, as I introduced him earlier, and he's going to give us some very timely, in-depth market analysis. So take it away, Steve.
Oh, wow. This is so great. You even built in a segue without even maybe knowing it, Rick. This is terrific because it just shows you that here at VectorVest, Dr. DeLito has instilled the system into us. I had no idea that that was what Angie was going to be writing about this week. I still haven't read the essay. And it's exactly what I planned on talking about today in this forum, is that relationship between earnings yield and interest yield. So hopefully, if you've been around the VectorVest family here for at least a little while, you're clued into the fact that there's three main things that drive markets around the globe. And that's going to be earnings, inflation, and interest rates. And of course, earnings is the engine that drives stock markets higher. And earnings, of course, has a couple of enemies, and they come by the way of interest rates and inflation. And so we know here the recent record then. I'm sure all of us are acutely aware. Inflation kind of went rampant there for a bit. Interest rates have kicked into gear to calm inflation, but there's a balance. There's a teeter-totter that boy, I tell you, the more you just listen to the words that he used to use and the analogies and everything like that, the smarter you realize that that gentleman really was. And the relationship of the teeter-totter is a beautiful description because the Fed has an incredibly difficult job in sticking to that dual mandate that they have here in the States and trying to balance that teeter-totter. And so it's like trying to set two equivalently sized elephants on each side. So, but you know, what we're seeing develop, what we're seeing happening here is interest rates have been on a shockingly rapid rise, of course, and we're now hearing rhetoric, you know, out of the Fed that interest rates are now likely higher for longer. And so there comes a breaking point here in the teeter-totter where if interest yield supersedes earnings yield on the S&P 500, then it makes very little sense at that point to take the extra risk in stocks when you can get what's considered anyway a much safer return and potentially an even better one by just taking, you know, the bond. So let me show you what we're looking at here in VectorVest, and hopefully please pay attention to Angie's essay. I'm sure that she's also indicated beautiful things to look at there. But one of the couple of things I had in mind, just the first things first. Oops, and I need to show my screen, so just give me a second here. Don't believe that I've done that yet. All right, and so I'm in VectorVest here, and of course here we can see, you know, the current home page. And of course, we had a pretty good rally in the stock market. Just this past Friday, there was a jobs number that came out, and I think that opens us up for a quick, brief discussion on events and consequences. So, you know, potential oil shocks. We're hearing about how OPEC is going to want to continue to pull back, manufacturing a tight market on crude, your war in Ukraine, you know, misleading headline jobs numbers like we had this past Friday. Sorry for the tinge. You know, where actually part-time employment was really what where all the gains were. There was a considerable loss in full-time employment here in the States. But, you know, all of these things, you know, if you want to concern yourself with them, you can absolutely get buried by all this information that's coming at you these days. Look, all of those things are events, and those events may or may not have consequences on corporate earnings. It's not until they do, you know, that we should really care about them. But we do need to understand that relationship of money goes where money grows. And so if I go over here into the viewers portion of VectorVest, if you go to the watch list section, there's an S&P watch list folder. And if you click in here, you can find just the plain old S&P 500 watch list, okay? And when you do, you can come down to this bottom, which will depict the average, okay? And when we come down here, we can see that the current earnings yield across the S&P, now, obviously, we're heading into earnings season, and I think that's one of the critical things on the short-term horizon is, do we continue to see the same kind of earnings growth in the S&P, you know, moving forward, that kind of thing. But it's important to know that the average earnings yield is about 5.5 roughly. And we saw 10-year and 30-year, I think even 2-year, if I'm not mistaken, all hit neighborhood of 5 at some point this week in terms of interest yield. So if we keep surging, if we keep clicking up, eventually interest yield is going to outpace earnings yield, and that's going to create a flock to safety, where at least, what has been the safest place to go in these kinds of times in the past. And so that's an important relationship to keep your eye on. Now, at the end of the day, we need to remain tactical. So that's sort of your 30,000 foot view. Okay. I don't want to go into all the reasons why interest yield is the enemy of earnings and all that stuff. It's just understand that the biggest part here is I can go get a safer return and at an equivalent earnings power potential. So with that in mind, right? Do we see it happening in the share markets yet? Are the share markets actually beginning to come to realize this? And I think they have. If you've been watching the stock market in relation to the 10-year, there was a huge jump in the 10-year on the back of the announcement on jobs, and then a quick deterioration. And what we saw in the stock market was the exact opposite. It was a big retreat, right, as the 10-year went up, and then this rally into the remainder of the day as the 10-year subsided. But as the 10-year has gone up, the stock markets have come down, and this is a change, from what we've seen, where for years and years and years, probably more than a decade, for sure, interest rates have been virtually zero, and so we're returning to normalcy here a bit. And you need to realize that. And now earnings and interest are going to, play a big part in your decision making. But we talked about it's not until we see evidence, that we need to worry about them. That evidence will at some stage begin to show up in earnings, and inevitably at some stage show up in price. So if we go over to the market timing graph, a couple of things are happening right now. Oops, I think I already have the charts open. Let me just see if I can get those down here. Give me 1 second. Oops, doesn't want to do that. Okay, that's fine. So this is your investment climate, and down here on the bottom, on what I have on the graphic here currently, is the most important part, and that's your 50-day MA on the earnings per share. This is of the S&P 500. Okay, what do we see happening with earnings right now, even at this time, even in the face of higher oil prices and all these other events that at some stage likely will have consequences? Are we seeing those consequences now? And we're not, but we are heading into this next earnings season, and I would keep an eye on this graphic. Now, it's going to take it some time to turn around, of course, so you want to stay focused on the VectorVest views each and every Friday coming up here for the next several weeks, because Angie always breaks down how many companies are meeting, beating, and exceeding earnings expectations from FactSet. And of course, that's going to be integral. And then you're also going to want to keep an eye on this ETI. This is our earnings trend indicator, which so far, guys, most people won't tell you this. I know markets have come down and people like to talk in terms of percentages about whether you're in bull or bear markets. We don't look at the markets that way. We look at earnings. And as long as earnings are strong enough and actually climbing over time and into the future, we say that the bull market is still intact. You got to remember, we had a meteoric rise in the stock market. So, and quite honestly, the pullback that we've seen here over the last year and a half is quite subdued, to be totally honest, in comparison to the rocket ship of a rise that we had. Okay, if this ETI works its way below 1, then you'll know that the bear market has officially begun, right? And things could get significantly worse for the stock market. So the good news right now, sort of the silver lining of hope, if you will, is that the earnings trend indicator, not only did it level not signaling bear market situation just yet. It's actually begun to climb again. So we want to keep an eye on it. Okay, that's the main, and realize that right now things are not as bad as a lot of the doom and gloomers that are out there telling you they are. They aren't. The economy is still quite strong. So we got to hope that we can push on down through here. And the best way to stay tuned to that is with this earnings trend indicator in your market climate graph. Okay. Now, knowing that the markets are not as bad as most people are professing, right? We can look for opportunities to still be buying stocks and figure there can be some upside available to us. So if we go then to the market timing graph, I take all of this stuff off. I want to bring to attention a couple of things. It does look like, after Friday's action, we are beginning to pivot here. And the question will become bottom fishing. Is it, Steve, one of the most important things maybe you can help us with, since this is your line of expertise, is it time to go bottom fishing for stocks? And the answer to that question is yes, quite possibly. Okay, so markets have come down. Is the buy-sell ratio below 0.2? Yep. Clicks that box. Buy-sell ratio is coming in at 0.1. That's a requirement. Okay. Is the MTI below 0.6? Yes, even better potential. Okay, for at least some short-term prolific rise in the stock market. Notice I use the term short-term there. Do I think that this is the buying opportunity of a lifetime? I do not. Do I think that we could get 3-4 very prolific days or a week or two of potential price action? I do. Particularly if some of these inflation reports this coming week come in a bit soft, and earnings, oh man, we're kicking off with the banks, aren't we? Maybe I ought to stifle my rhetoric down a little bit. But we'll see how earnings, I don't think we're going to have a good picture on earnings until we get into next week. We'll see. Hopefully there'll be some surprises. Remember, it was Citigroup, right, that turned our attention to the fact that the financial crisis was over not that long ago. Well, I guess it was a long time ago, 2009. So you just never know. And what we got to do is we got to not let all of those clouds come into the sky for us. We just got to stick to the facts. We know that when the buy to sell ratio is down here and the MTI are down here, and we get a blast off day or a primary wave up with confirmation, we like to kick a campaign into gear here, just knowing that the likelihood and the probabilities of success are on our side by how bloody the stock market has been. Okay, so not all bottom fishing opportunities end up being as good as another. But we last year, in the midst of just an awful market, we went bottom fishing in our jockey club 5 times. 4 of them were successful. 1 of them was not, and it was pretty bad. But the 4 that worked, we ended up net on the year last year more than 30% gain just buying stocks over the course of 3 to 4 to 5 days on these campaigns. So notice what I said there. If you're not comfortable with 3, 4, or 5 days, again, I'm not. You never know for sure, but I'm not sure if I'd want to, go lickety split into a bottom fishing campaign if you're not ready for that amount of risk. Okay, if you're not, you want to wait for more signal, and that would be, I would say, a green light kicker. Not even the first green light necessarily, but one where the moving averages, you get the blinking gold star in the price column. That's traditionally your best bet after a substantial pullback in the stock market. Okay. So why wasn't Friday, Mr. Chappell, a blast off day? I got a ton of emails on this, and I was able to walk a few people off the ledge and into patience. And we saw the market sell off towards the end, and that was part of the misleading jobs number thing that I was alluding to earlier. But I just didn't see it, and here's why. A blast off day has always been a day in which the last thing that you want to do is call Mr. Chappell to see if today is in fact the blast off day. A blast off day feels like the 30 seconds even it would take to call Mr. Chappell to figure out if it's a blast off day is a complete waste of time. Okay, so generally the markets open up multiple percentages and they never look back. I mean, they are just running away from you at such a speed you cannot get the orders in fast enough. That is a blast off day. It's not a big candle on the VectorVest composite. It's a feeling, okay? Now, if we don't have one of those days, which we haven't had yet, we might have Monday, we'll see, right? What we look for then is the primary wave to turn up and then confirm to be the safest. So you have this window of time from what is a market low. The first thing that can happen is the blast off day. The next thing that can happen is the primary wave turn up, and sort of your last good entry on trying to get the most out of a campaign is with confirmation. So prices are trying to turn the corner here. And when we look at it, just real quickly, I think this is 5 days ago on Monday. So if we go 1, 2, 3, 4, 5, I put this dotted line right across the close for Friday. Prices need to clear that hurdle Monday, feel like we're on a roll, and you can consider pulling the trigger. If you want to wait for that final bit of confirmation, you wait for follow through the following day. And that has, on sometimes, actually saved people's bacon. So look, it's still super quick to get into the market next Tuesday. You're talking, potentially what, 3 or 4 days off of a market low? And relatively speaking, the prices have not really gone anywhere yet. So if I look at something like the Derby, for example, I'm not seeing any bottom fishing searches in the Derby. Blyers had the biggest day on Friday, and it was up 2.82%. They're not running away from you yet. So that's the other telltale sign. We're not seeing the bottom fishing searches explode. And so I think what folks are doing here is, instead of going full on risk, they're starting to buy these big tech stocks again, your Teslas and your Nvidias and things of that nature. But if on Monday that paradigm changes, and you start to see in the VectorVest views, we report on the top Derby strategies. So if I go into the views, and this is every day of the week, what we want to see to feel even better about deploying a bottom fishing campaign is we want to see bottom fishers show up in this list. So you got one, it's called bottoms up. This is not a traditional bottom fishing search, but it's a recommendation profile change. These stocks aren't quite as bloody as something like bottoms up because they had to have been a buy consecutively already. Okay. So in terms of traditional bottom fishing, well, what are those strategy names if I don't know them? You can go to Unisearch, go to search as bottom fishing. You're looking for these names right here. Most notably, you're looking for Jailbreaks, Blyers, Russell, S&P. You're looking for these names in that list. And given kind of the lay of the land that we just put out there for you, you might want to go on the moderate side of bottom fishing on this particular campaign, knowing that, we don't really see anything kicking into gear quite yet. So look, if on Monday Jailbreak's up 20% at the market open, that's probably the right one to choose. But if that's not the case, we're getting that primary wave, things look good. Some of them are I'd probably go with a Blyers or an S&P, something that's got a little bit more of a moderate price point that can still do a lot of good work on a short-term basis for you. You're not going to be upset with any of them if we get it right, even the blue chip ones. Okay. All right. So hopefully that clears the air a bit there. And I'm sorry, Ray, you're probably feverishly answering questions and back on that. But just tried to lay that out there as well as I could, as methodically as I could. So could we go bottom fishing early next week? In summary, yes, we could. Now you know what a blast off day feels like. It feels like I don't want to take the time to call Mr. Chappell or VectorVest. That would be foolish in itself. I'm wasting time. That's what a blast off day feels like. If it doesn't feel like that, let's wait for the primary wave and markets to be rolling higher for the first 15, 30 minutes. And at some point, you got to pull the trigger. And if you want to play it with the most safety possible, you give up a little potential return, but wait for Tuesday and the markets to continue rolling. Okay. Now, again, this is not March 2009. The best bottom fishing opportunities happen after the recession. So you got to keep that in mind here as well. And so for many of you that are in this room, not all of you, I know at least Jay and some others. I heard Jay was here earlier. There are some of us here, including me, that are willing to take a swing because you never know. Sometimes some of the worst seeming opportunities turn out to be the best. We're willing to swing the bat, but we also realize that we're taking on a little bit more risk here, than you normally would. So hopefully that cleans it up. If not, wait for the green light, hopefully with confirmation. And at that point, you feel pretty good. I mean, you feel as good as you're ever going to feel. After a C down, green light, confirm green light, you feel as good as you're ever going to feel in the VectorVest world about buying stocks again. Okay. All right. Yeah. And the other thing, just to kind of keep your eye on, we were watching this in the Jockey Club, kind of coming into the week, and Susan, start getting ready because I'm about to turn it over to you, I think. We've been watching the S&P, and I've got two moving averages on here. I've got a 50, which is the white line, and I've got a 200, which is the blue line. And we held support for 4 consecutive days and bounced off of that. So I think there's a good bit of technical trading also in this market, and rightly so. If you're going to find some support, you've already pushed through the 50. You can see there was a battle there a few times. Your next logical zone of the battlefield is the 200. But keep an eye on this 50. What we don't want to see, hopefully we'll get enough bounce here, right, to stave off the 50 crossing below the 200. Because if that happens, let me show you a couple things here. Markets tend to go, they can be volatile, but they tend to go quite a bit lower over time. And these were actually some of the bottom fishing opportunities that I was talking about earlier, okay? So you can still make money long by nailing these bottoms, even in some of the worst markets. But what we really like is when the 50 is above the 200 and holding divergence. What we don't like is when it starts to curl, realizing, ding, 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 that even as this is underway, you can still have some rallies, but how long was it? Okay. You can still have some rallies, but how long was it? Okay. I think that's the best depiction. That's the best picture I can give you right now, is this one right here. Until this starts to happen again. Until we start to see the market really pick up some momentum back to the upside, okay? And you'll notice if you go back and do some study, you can have some pretty good sharp. Here's what happens in bull markets, in full-blown bull markets where everything is still rosy and there's no potential torpedoes in the water, okay? You have long protracted upturns and short, quick downturns. As that paradigm changes, and interest yield starts to, eat into earnings yield, and bonds become more attractive than stocks and all of this, what tends to happen is here we're rolling, potentially anyway, into a market where you're going to have longer, more protracted downturns and shorter, more prolific, quick upturns. And that's the best picture that I can paint for you right now. So VectorVest is always going to be here for you. I want you to continue to trust the system as it's written, because that's what I'm going to do. If I get a green light with confirmation, I'm buying stocks, people. I'm not saying, we're going to follow the system, right? But you need to know the lay of the land. I think both of them are important. And, your next best buying opportunity may even be better than the one that might be presenting itself now, okay? And so just hang in there. Be patient. and trust the system. The system for 22 years has done nothing but help at least little Stevie over here. And if it can help little Stevie, it can help any of you. So just trust it, and I'll turn it back to either Rick or Susan, depending on how you want to run this, Joey, and we'll go from there.
Thank you very much indeed to little Stevie, who has walked us through all of that. And every time that I see Steve present, whether it is in person, which I have been grateful to do, at a money show when we've been on the road, or when it's in North Carolina, which again, I've been lucky to be there, as well as, of course, online. It's always a great education. So thank you very much, Steve, for that. I do want to point out that indeed, whether he intended to or not, he also gave me a great segue into talking through the range of points that I have to share with you today. So I'm going to take you through those one by one. And I'm going to start off with the point that Rick has started off speaking about, that Steve started off talking about, and now I'm just going to square the circle by just finishing off on this point, and that is this whole conversation about earnings yield versus interest yield. So I was watching what was going on there in the chat, and obviously a shout out there to Ray, who's diligently taking care of everybody there on the chat. But I did just want to make this point. Steve said, if I can put my money on deposit and I can get a return that either is at or above that what I can get from the stock market, well then of course a question does rise around, why then would I invest in the stock market at all? And what Steve did very well there is he took us into that watch list, the S&P 500 watch list. He brought us right down to the bottom of the screen. And then he showed us the earnings yield, and that is where that number comes from. Now, I was interested there when I was looking in the chat, and I just want to go back to the person that says that, just point out about, it's up there anyway in the chat, about something guaranteeing something. It's not that this guarantees it. This isn't a statistical analysis, but think about it. If you could put your money on deposit and then you could get the same return than putting your money at risk, well then why, statistics or otherwise, would you do anything different? And this is the thing that Angie is writing about. This is what Rick was talking about. This is what Steve has elaborated on. So what I just want to do was I want to connect 2 points together that Steve mentioned, and that was, why is it that when we got that jobs report last week, why is it that this has been driving the interest yield? So Steve shared there with us, for example, that all of the growth in jobs data that was released last week was primarily, and by the way, when I say last week, of course, I mean this calendar week, but last working week. What that means is that there is more growth in part-time jobs versus full-time jobs. The decline has been the full-time jobs. But it's just an interesting point that Steve shared with us before we came online here that I wanted to share with you all, and that is, there are more people today in America with more than one job than ever before. So what does that tell us? Does it tell us that jobs are abundant? Perhaps. Does it tell us that people need more than one job? I think that's the real story. So where does that then take us? Well, it does say, well, if that was to turn, and bear in mind where interest rates are, bear in mind what the Fed has been trying to do, and the ECB is trying to do, and the Bank of England is trying to do, they're trying to manufacture a decline in economic activity to drive down prices. So if that, of course, happens and manifests itself into an outcome, which of course it has been doing, as we've seen, slowing inflation, well, then of course you may see a rise in unemployment. Now, if you then see people losing their jobs, well, then what do you need to do? Well, then, of course, the government needs to step in and provide social welfare for them. So all of these things, of course, point towards not just uncertainty, but a decreasing sense of stability. And that is why the bond market then says, oh, well, if we're going to lend to the US market, well, then we are going to demand a higher interest rate for it to take on that risk. And that is where I'm now going to share my screen. And I'm just going to, as I say, connect this all together by pointing out the key story that was shared. Oh, where's my team's gone? I need to minimize one window and the second window. Yeah, to bring it back here. All right, now let me share my screen. Here we go. And now let me bring that back up here for you. Okay, there we go. And that is this here, the Bureau of Labor Statistics data data, which easily surpassed expectations of 170,000 new jobs, reignited the bond sell-off that has swept global markets over the past 2 weeks. When bonds are sold, then the interest rate goes up. And 10-year US government borrowing costs reached their highest point since 2007, after the publication of the 336,000 figure, which was also far above August's upwardly revised total of 227,000. So there you go. The 10-year borrowing costs reached their highest point since 2007. There you go. This is exactly what Angie is writing about. It's what Steve is talking about. It is what Rick has referred to. But I just wanted to square that circle and say all of them have looked at this from a stock market point of view. I just wanted to balance the books here and show this is what we're talking about. And this is why we are talking about it. And of course, this then is where the concern has crept into the stock market over the past while. So that's the one to watch. Now, I also wanted to answer the question that indeed Ray has already referred to in the chat, just about where are our essays. And let me pull this right up here for you. Okay, so here is the VectorVest program. If any of you are not familiar with this, then I would ask Ray or Joy to please drop a link to the trial into the chat so people can access it. Those of you who have been here forever, you will know exactly what I'm looking at. But if you pop on over here to the views, in here is where we have the views, and specifically here is where we've got the essays, and then respectively from there, this is where Angie's essay is based around exactly what I'm talking about. But what I wanted to do, and I wasn't going to do this only for Rick actually drew attention to it today, which I know he always does, so I should have known he was going to do it, but I do just want to tell you this. A very brief story before I get into the earnings report. I was in San Francisco at the Money Show. Steve was there, Ray was there, a couple of the other people in the team that you may or may not have met were there. It was my first time on the road with the team in the US. Now, I'd been on the road, of course, in Europe, but not in the US. And Dr. D was sitting right up the front, as he typically would have done. He always loved to talk to subscribers and listen to the way in which we were presenting. And as you can imagine, give us feedback on how we were doing as well. But one of my favorite indicators in the system is the comfort index. And the comfort index is a stock's ability to withstand severe and/or lengthy price declines. Now, while that might sound very technical as a definition, what I want to do is I want to illustrate my views to you today. Rather than you having to go into the European system and find them and everything else, I'm going to illustrate to you today what I did that day in San Francisco. And this is where I heard Dr. D turn around to somebody and say, look, she can predict the graph. And that is why I chose the title of my views for this week. And here is how I can predict the graph. So if you go over here to viewer, okay, I'm going to go to my viewer's home and I'm going to go to my stock viewer. Now, again, for any of you that aren't familiar, because I don't like assuming everybody here today is familiar with the system, because then we can lose people. And I don't want to do that. And similarly, for everyone who's very familiar with the system, bear with me, I won't be long. The viewer is a list of all of the stocks that we track in each country's database. And I say that about the US, I say that about Canada, I say that about Australia, I say it about the UK, but I don't say that about Europe. Because in Europe, what we do is that we have a database of stocks that are listed and traded in euro. So as I'm sure you're aware, the Eurozone consists of a range of countries, including Ireland, where I'm from, in case you didn't notice, and also Portugal, France, Spain, Germany, etc. So as you can see here, in our stock viewer, we've 9,162 stocks. And this is what I did that day in San Fran. I went on over here to CI, and CI is the comfort index, okay? And what I did was I ranked, and I've just done it there now, I've ranked all 9,162 stocks there in terms of, see them? Okay, Vista Energy is at the top, Granite is second, Limback is next, Granite, Moon Lake, Sterling, Core America, ELF Beauty, Rolls-Royce and Powell. Now, you could do this right away this minute. If you were to go into your own system, if you did exactly what I've done, you would get exactly the same result. We have now listed the entire 9,162 stocks in terms of comfort index. Again, I will repeat what this means. A stock's ability to withstand severe and/or lengthy price declines. Now, this is so against your bottom fishing sort of search, right? This is not short term. This is where the CI looks back over a period of time and says, well, what is the stock's ability to withstand severe and/or lengthy price declines? But still, that still sounds quite wordy. So what I want to do is I want to show you exactly what the CI does. What the CI does is that it shows you a list of stocks where the stocks start at the bottom left-hand corner, the graph, and it goes all the way to the top right. And this is how, this is what I'm predicting is going to happen with these stocks. And if I was to go back to any day over the program's history, I would say the same thing, right? So let me just graph them all. Here you go. I'm going to graph them all. Okay. And look what happens. Oh, here we go. Bottom left to the top right. Okay. Next one. Bottom left to the top right. Now, admittedly, this stock only started in the 28th of December last year, but still, right? Shape of the graph's the same. Bottom left to the top right. Bottom left to the top right. Bottom left. Let me just, I can expand it there even further. Bottom left to the top right. There we go. And again, and again, and again, and again, right? So how was I able to predict the graph? I'm not able to predict the graph. The CI is what does its thing. What the CI does is it shows you the stock's ability to withstand severe and or lengthy price declines. And it basically shows a stock's resilience over that period of time. And the reason I look for the CI is I am an options investor. I am somebody that likes my dividend yielding stocks. I like seeing stocks move from the bottom left up there to the top right. And that over the course of my essays at the moment, I'm on week 4 and I'm going to run this all the way up to the end of the year. What I'm just sharing are nuggets of wisdom that I got from Dr. D, or else memories that I have. And that was one, is where he turned to that person in San Francisco and said, look, she can predict the graph. So just in case any of you don't have access to the views because you're not a subscriber and you'd like to know what I was talking about, that is what I was talking about. And for any of you who is familiar with the VectorVest system, check out, for sure, check out the views, or views that the CI. Okay, now what I'm going to do next is I'm now going to move into what I wanted to talk to you about today, which is how to read an earnings report. Now, it's my job to make sure that I am on time for you and that I make sure that we deliver the International User Group Forum within the right period of time. So it is now coming up to 3 minutes to the hour. And I promise you, I will take you through exactly what I wanted to speak about between now and 25 past the hour, when I'm going to hand us back over to Rick so that then he can bring us home. So I'm taking care of the time so you don't have to. Now, what I have done is in Unisearch over here, I have created my own search that helps me figure out the earnings reports that I want to look for on a daily basis or a weekly basis. I've shared this before in the last user group, in the last International User Group Forum, and I'm just going to refer to it here now. Okay, so as you can see here, what I look for is I'm looking for earnings releases that are between 5 and 10 days out, and this helps me plan. Right, of course, if you wanted to look at this every day, well, then you might have it just where it's 1 day out. But what I like to look for are stocks that are releasing their earnings in between 5 and 10 days. I want to see the VST above 1, and the VST above 1 means that the value, safety, and timing are all collectively above 1. I want to see that the stock's relative safety, I want to see that that is above 1.2, and that means a stock's consistency and predictability of financial performance. And that means dividends and earnings. Dividends if they apply, but specifically earnings as well. And then relative timing, I want to make sure that the buyers are pushing up the stock faster than the sellers are pushing it down. And that is RT above 1, means that relative timing is favorable. And that's my search. Okay, that is my search. This is how I define what it is that I'm going to look for in the days ahead. Okay, now I'm just going to take a look over here just to see if there's any questions or anything coming up there. And I see that there's great chats that are happening over there as regards ETFs and baskets. So that's all good. Okay, if anybody does have any questions, Ray will answer them, of course. But if there's anything you want to put to me, please do. Okay, now I'm going to run this search. And now you'll see the stocks that I'm going to be watching out for the week ahead. We've got Progressive, we've got United Health, and we've got Fastenal. And Fastenal had a phenomenal reaction to its earnings in the last quarter. Now, I do want to point out, because this came up last month, and of course, any of you can go back and look at last month's the International User Group Forum, and you can see what I was saying then. It's the same search, right? And that time I was walking through Lululemon's earnings. Today, I'm going to take it through something else. But I was struck by a couple of things that came up in the chat about the problem with earnings is when they happen, the news is out. And of course, you can't trade on information that's already out, because a bit like Steve was saying there about blast off day. You know, when blast off day is happening, you don't want to be ringing Steve and asking him, is it happening? You want to be acting. And Rick brought this up at the end of our session last month about the fact is, if you're trading off information that is already released, well, then, of course, the information is already out. So then there needs to be new information to drive that, unless, of course, you're investing over the long term, and then earnings and the P ratio will drive it. So I really want to point this out to you, and I want to be super clear about it, is this search shows me the stocks that I want to look at before the earnings are out. This is the point I want to make. When I was going through Lululemon's earnings last time, that earnings was out, because I'm here to show you how to read an earnings report. But what I particularly want to show you how to do is how to use the VectorVest system to find the stocks that are doing what they're doing before the earnings comes out, so that you're aware of what might potentially stand out and what might be an interesting opportunity perhaps to look at. And that's the difference here. This search, as you can see, I just want to reinforce the point, the earnings date is greater than 5 days out and less than 10. And you can amend that according to your own calendar. But I do want to make the point is that these stocks then are the ones that I'm watching before the earnings are released. And when I say I'm watching them, some of them I might buy, some of them I might sell a put on. If I feel that there's going to be a lot of volatility, but I'm not sure in which direction, of course, I could buy a call and I could buy a put. And then if the volatility is such that it's significant enough that it can drive up the price of one of them, well, then, of course, whatever you might lose in the other then becomes irrelevant. So this is, again, I just want to finish off on this point before I get into actually analyzing the earnings report for you this month. This search that I have here points out the stocks that I find are interesting opportunities before the earnings come out, so that then I can actually benefit from what happens to those stocks after the earnings come out. Okay, let me see. I'm just taking a look over there. Seems the conversation is continuing, and that's super. All right, now what I'm going to do here next is I'm now going to show you what happened last Friday, right? So when I ran the search last Friday, here is what happened last Friday, and we press run the search. Okay, and we had AEHR test systems, okay? And look at what happened when I then ran the search on, I'm going to pick here, say, for example, last Wednesday, okay, run the search. No results found. When I ran the search this Thursday, okay, sorry, because I want to go at least 5 days behind, not this Thursday, last Thursday, that is the 28th here, and we run the search, and okay, I have the same one, and then let me get another one here, let me go back to same one to the 25th, and we run the search. As you can see, there's very, very few results found. Although I had very little to go on over the past while, very little, and that is because the market is nervous. It is nervous, and as a result, I'm not getting my RTs above 1. I'm not finding the stocks with a VST above 1. I'm not finding my stocks with VST above 1.2. I'm not getting them. And I'm also determining whether I want to add in another parameter in here, and that is a buy recommendation. Because if I want to be even more stringent again, REC is equal to a buy recommendation only. Now, I could take out VST being greater to 1 now, and I could take out that the RT is greater than 1, because both of those are baked into the pie here of the stocks recommendation being a buy. Then, as you can see, it becomes even tougher again. And then if I go back to last Friday and I run the search, I don't have anything. So then I thought about, okay, what am I going to talk to you about today? What am I going to talk to you about today? If I don't have a stock to analyze its earnings because of the search that I've built, where does this leave me? So what I wanted to do, and what I have done, and what I am doing with you instead, is that I decided to take a different approach. And this time, instead of finding for you a stock that I would buy, or a stock that I would sell a put on, or a stock that I might buy a call and a put on together, what I wanted to do was I simply wanted to go through an earnings report of a company who released its earnings yesterday. Okay, so here's how I can find that, and I can do it super simply. What I did is I'm going to go over here to Viewer. I go down to Events Viewer, and when I go into Events Viewer, and I'm clicking on my Events Viewer here, and it looks like my system has gotten, oh, here we go, all right. And Wednesday, Thursday was Thursday, and when I say yesterday, by the way, I don't mean yesterday as in the calendar week, I mean the stock market yesterday, and the stock market yesterday in the context of where we're at the moment would be Thursday. So I first of all looked up Levi, right? I had a look here at Levi Strauss. I'm sure an awful lot of you, if you haven't worn a pair of Levi Strauss, you're familiar with somebody that did. And I took a look in here at various different stocks, and I'm finding a similar trend in a lot of them. is a lot of them didn't have a great reaction to their earnings. Now, this happens when you've got an earnings season where people are nervous, where the market is nervous, where the bond yield is going up, where there's uncertainty, where there's instability, etc. So what I said I would do is I would look at the stocks, and whereby I could see that there was a positive reaction to the earnings, and I wanted to show you how I could dissect that for you. So where I'm going to bring you is Conagra Foods. Now, Conagra Foods, I'm sure an awful lot of you have not heard of it before, and that is because it is a series of companies, a series of brands that many of you will be familiar with. So this is Conagra Brands release their earnings on Thursday morning, and you can see here. So I'm just gonna ask there in the chat. Let's just hear how many of you are familiar with these names, with Slim Jim, with Birdseye, with Boom Chicka Pop, with Snack Pack, with Jukes, with Ready Whip, V Classic. How many of you are familiar with all of these? These are all the brands that they have, right? Just want to hear there in the chat, how many of you are familiar with these various different brands? This is, I'm going to show you the market cap in a moment. This is over a $12 billion company. Yeah, okay. Richard, just checking in here. Richard said, thank you for this search. Last month I used it to return a nice gain in Oracle. Brilliant, Richard. I'm delighted to hear it. Like, this is the point, is that it's a search that is designed to help you find the stocks that are likely to have a solid reaction to their earnings. That's the name of the game here. Let me see here. Julie said some of them. Sandy said yes. Jake said yummy yes. Tom said yeah. Okay. Margaret said some of them. Marguerite, sorry, said some of them. Brilliant. Yeah. Okay. Great stuff. Glad to hear that. Now, personally speaking, I was more familiar with Birdseye than any of the others, and I would think that our American friends here with us today are likely to be more familiar with some of these names than others. But this is the name of the company that I wanted to bring to you today. Now, is Conagra likely to have appeared on my search? Absolutely not. Absolutely not. Is it likely to appear on one of Steve's bottom fishing searches? Yes, that's a far more likely place for Conagra to be hanging out. And while he was going through his search there in the background, I was actually looking to see if I did find it. Now, I didn't get through all of the bottom fishing searches. I had a look at the S&P 100 divided by RT, and I had a look for it there, and it's not there. But I'm going to show you why I think you might find Conagra at that place. So let me just go here to home. Let me just put in here CAG, and here's why this would not appear on my search typically. Number one, it has a sell recommendation. And you might say, hang on a second now, Susan. Since when does VectorVest talk about buying stocks with a sell recommendation? Well, it doesn't, right? It doesn't for a start. And I'm not talking about buying it. I'm talking about how to dissect its earnings. But what I am saying is that you might well come across a bottom fishing search that has sell recommendations. That certainly you can, and if Steve was back here and if we put him back on screen, he would attest to that. Big, and remember even the search he showed you of the SSS-BB. So we are familiar with looking at stocks, and that when you're looking at bottom fishing, that kind of sell recommendations. But here is why they might be good bottom fishers. Let me show you the graph, right? Now this graph it's a hold your nose sort of a graph, right? Stock is down 31% year to date. It peaked on the 9th of January, and as you can see, it has been falling since. However, look at what's happened in the past 5 days. There we go. This is what has happened since the market opened and the earnings came out. You can see here that there has been a positive reaction to the earnings. And this is what I wanted to show you, a very significant positive reaction to the earnings. The stock has gone from 25.21 up to and closed yesterday at 26.41. Okay, so I want to show you why, and I want to show you what investors look at in an earnings report that can actually deliver that. Okay, so let me now get in there and show you exactly what I'm about to show you. Okay, right. The key thing here, for those of you who want to say, right, just give me the short version super quick. I'm going to give you the tweet length version of this super quick, because I was tweeting about this earlier on my morning, because in Ireland, of course, we're at a totally different time zone to many of you who are here today. And look here, this is one of the things that I wanted to point out. This is a direct quote from the earnings call. They are the household. They have shifted from meals per one to meals per many, even if not everyone is at home at the same time to eat together. And this last shift I will mention is a reduction in wasted food and an increase in the use of leftovers. So let's just think about that for a moment. And I just want to briefly talk you through what, I'm just going to stop sharing there for a moment. Let me just talk to you a little bit about what's going on in households around the world, because we need to understand those shifts in order to get a good and solid understanding of what's going on with Conagra. And I just want to let Joey know there that I've stopped sharing there, Joey, and I will be back sharing there in a little while. So, okay, thank you. Now, here's a couple of things about what's going on, right? First of all, inflation is well and truly, that's not a new story, right? That is a 2022 story, very significantly a 2022 story. But how has the household been handling it? Okay, well, number one, there can be a product shift that so instead of buying goods and services, but goods in your higher price stores, then there can be a decrease, of course, a decrease in your price so that they go more so towards your discounter. That can be one thing. Number two is there can be a decline in the amount of things that are bought, of course, as well. There can be more of a focus on looking for special offers. And then, of course, there is also we would call them in the stock market, a decline in inventory. But what that means in a household is that people use what they've got rather than buying new things into their pantries and into their fridges and into their presses, etc. And this is what Conagra is spotting, right? This is happening, but on a much bigger basis, of course, because it's now seeing the impact right across the board. So what they're seeing is they're seeing lower volume, right? Number one, the company is seeing lower volume of goods being bought. Number two, they're seeing a decline, households using up the inventories that they have, and then that's driving the volume. And then, of course, the other thing is they're seeing people using more of what they've got and making it stretch further. That's why they're seeing, instead of prepping a meal for one person in the household and then somebody else prepping a meal for themselves, is that there's more of a prepping together. And then the other thing that they're seeing happen is that there is an increase in the use of leftovers, or a decrease in the amount of leftovers in the first place. In addition, of course, what people are looking for is they are looking for better value, and therefore they are also looking for goods that are available at special offers. And this is also being factored into their price mix. The interesting thing, though, is that what Conagra are seeing on top of that is that they're expecting all of that to be temporary. There is only so much food in one's house that can be used up before you have to buy more. And they're seeing households now using up the inventory that is in their households from arising from the pandemic. And here are two interesting shifts that are happening. Number one, they're seeing an increase in tinned foods and foods that have got a longer shelf life. And number two, they're seeing a decline in refrigerated foods. They're seeing a decline in that because, of course, there is a shorter shelf life, and that's why things are being refrigerated. And that's the story. That's the narrative that I wanted to put forward to you today from Conagra. If you go in and you look at the earnings call transcript, you'll see that. But if you go in and you look at the company's own guidance, you won't. And this is the point I want to make about how to read an earnings report. You can go in and read down through the slides and the infographic, but you won't get the nuance. You can go and read the earnings transcript, and that certainly is really useful, and I do it all the time. But what the best thing is, in my opinion, is to listen to the earnings, the earnings call, go back and read the transcript, and also make sure and pay attention to the Q&A. I say this every month. Make sure and pay attention to the Q&A, because the analysts that are sitting and being on that call live, who are putting forward those questions, are taking in that information in real time. They're spotting the holes in the argument. And by the way, in many earnings calls that I have been on, there's some beautiful, gorgeous language that can be used by the company that the analysts can cut through the mustard really, really quickly. And then also what the analysts are very good at doing as well is saying, well, a quarter ago you said X, or a year ago you said Y, or I was on another earnings call by your competitor this week and they said something else. How do you compare? What is the competitive landscape like, etc.? And that's the nuance and the beauty that you get in the transcript. Now, I wanted to share that as the narrative. Okay, that is underpinning what's going on in Conagra's story. But now what I'm going to do is I'm going to talk you through a very tweet length, right? That's all. I'm going to show you a tweet length summary of what the earnings report said from a financial point of view. Okay, and this is it. It's another quote from the earnings call. Our Q1 adjusted EPS earnings per share increased to 66 cents, representing a 15.8% increase over the year. Now, there you go. That's why the stock is up. That is why the stock is up. Now, since this is the tweet length, right, and this is a new Elon Musk double the tweet length, right, if I had to summarize it down even further, I would have stopped there, and I would have also added in one other point, and that is that this quarter, the EPS swung from a loss to a profit. And that's another key reason why, of course, the market responded well to the earnings that came out. Now, what the market didn't like is that sales are flat. What they didn't like are some segments are down. What they didn't like is some volume is down, etc. But fundamentally, what it comes down to is this. The earnings per share increased to 66 cents, representing a 15.8% increase over the prior year. And that's really important. Now, what's driving that? Well, number one, higher adjusted gross profit. And this is what's really, really driving it, as distinct to the next bit. So a gross profit is this, right? Let's say that I'm making a popcorn, right? That's one of their products. I'm going to make popcorn. And we, in the business, we make the popcorn and we put the popcorn into a box. That product, let's say, I'm going to say costs $10 and we sell it for $20. My gross profit is $10. What have I not spoken about? Well, I haven't spoken about delivering the popcorn. I haven't spoken about the marketing staff. I haven't spoken about the wages that we have to pay to people who are administering the procurement and supply chain. I haven't spoken about the accountant's fees. I haven't spoken about legal fees because they're all below that in the P&L, in the profit and loss. So higher adjusted gross profit means that the company has become more efficient in the production of its actual product. And then it moves on to what happens below that before we get to net profit, which is and slightly lower A&P. So what's A&P? A&P is advertising and promotion. Now, again, I think, look, I'm responsible for the profit and loss statement here in VectorVest of VectorVest Europe. I know exactly what is involved in when you decrease your A&P spending. Well, then perhaps it's more efficient, but also perhaps then you're losing out on the people that you can reach. So personally speaking, if the company was to keep decreasing its A&P, then it would certainly not have a knock-on effect on the top line. So slightly lower A&P is probably a short-term thing. I certainly don't want to see that happening over the long term. And remember what I said to you last month about Lululemon. In Lululemon's case, what they do is they have a fixed percentage of sales that then goes in to reflect its marketing budget. So if sales are going up, well then of course promotion is going up as well. So in this case, in the case of Conagra, we're seeing it lower. And as I say, I think that this is going to be a temporary change. And then it's also adjusted SG&A. What is SG&A? Sales, general and administration. That's what it is. It is the costs that I mentioned aren't reflected in the gross profit. Okay, so sales, general and administration. So that is the costs of marketing, the costs of general administration, the costs of the accountant's fees, the legal fees, etc. Okay, so higher adjusted gross profit, lower advertising and promotions, and adjusted sales, general and administrative expenses were the positive contributors to our adjusted EPS performance in the quarter. That is the summary. That's it. That is the summary. Now, what I'm going to do in the remaining 7 minutes that I have is now I'm going to bring you on a rapid fire round of where we can find the substance. Okay, so this is over here. What I can show you here, this is the substance behind it all. What Conagra did very helpfully is that they put together a great infographic. Now, I find myself, maybe you'll be different, but I find when I click on this and I open it up as a separate infographic, that link doesn't let me, it doesn't work. So, and I know that if I increase it like this, I just don't know whether you'll be able to see it as clearly as I want you to see it. So I'm just going to quickly bring you through the main points here. Okay, first of all, it had a decline in net sales, organic net sales, right? And that the market didn't like that. If you were to look at any other analysts looking at the earnings report here of Conagra, you will see the headline like mixed results. And I just want to tell you, again, I'm just whittling down. Now that I've told you the story, I want to translate the story into the numbers. What happened here is they had a decline in volume, a 6.6% decline in volume in their sales, but there was a 6.3% increase in the price of those sales. And as a result, when you put the two together, therefore, it utterly ended up being broadly flat, but slightly down. Okay. This is the big one though. This is the really big one. And they talk about this a lot in the earnings call, and you'll see it in the transcript if you look for it as well, is there was a 272 basis point adjustment to the gross margin growth. Now that's significant. That is significant. That is what an investor wants to see translating into something more sustainable over the long term. 272 basis points means they had an improvement of 272 basis points in their gross margin. So that means that, let's say, it costs $10 to produce the popcorn, we're selling it for 20. 272 basis points means we're still producing it, we're still selling it for $20, but let's say now instead we're charging it around about $8 for it. And then of course you can capture the gap in between, and not just this time, but if they can sustain that, well then of course that will have a consistent impact on the bottom line. And if it's on the bottom line, well then it will affect earnings per share as well. And then this one, and this is even more significant in my own opinion, which is 297. Okay, so this is a bigger one. 297 basis points of operating margin growth. So gross margin is just up at the top. It is you're producing your popcorn, $20. It used to cost 10 to produce it. Now it costs 8. Whereas instead your operating margin is, it costs us, let's say it costs us $12 to produce everything, including the legal fees, the accounting fees, the delivery and everything else. Now that has dramatically improved by 297 basis points, which means, again, not alone is the gross profit improving, the whole way down, the whole operating margin is improving as well. But we can see that that's primarily driven by the growth margin, the gross profit margin, and then with the improvement as well of A&P and SG&A, as I've already explained in my tweet length description. Now, I want to come down over here then to summarize where that's going. And that is that the adjusted operating margin then moves from 16% to 16.5%. And that is, I'm far more interested in that number than that one. Because what this is telling me is that as sales continue to grow, which of course the company feels that those macro trends are temporary. So if it can do that, if it can continue to establish and maintain its market share, at the very least without a new product or gaining market share, well then this is what is going to drive the earnings growth. That is, as I say, why investors are responding well. And that's why down here, your adjusted earnings per share then moves from 270 to 275. Then they talk about their various strategies and so on like that. But I just want to skip down past that and also point out that not every company makes my job as easy as it is in the case of Conagra. They actually share the highlights here with us. So in the remaining 3 minutes that I have, and then Rick, I'm going to go back to you. In this here, I can now see the highlights. So I'm just going to explain very briefly what these are. First quarter net sales were flat to the prior year. Organic net sales decreased by 0.3%. I've explained exactly why. Operating margin in the quarter was 16.8%. Operating margin this is the profit from their actual operating business. It excludes anything that's infrequent and exceptional. This is what we want to see. This is what we really, really want to see. And then they're also pointing out that it's a 1,757 basis point increase over the prior year quarter, which is striking. The fact now that is a very, very significant improvement in just the efficiency of how the business is running. And then you can also see what I had told you earlier about the basis point increase as well. Okay. From adjusted operating margin. Diluted earnings per share, we've already spoken about that. And I told you this is what I put into the tweet because this is what it really boils down to. And then also the company is reaffirming its fiscal 2024 guidance, reflecting the organic net sales growth of approximately 1%. Now, that, of course, is muted. A 1% growth of sales is muted. So the company can make itself more efficient, and it can do that through supply chain. It can do that through improving costs. It can do that through rationalization. It can, of course, it can do all of those things, but it cannot keep making itself more efficient and growing into the long term. This is what needs to ultimately drive the business in the future. And this is what we'll need to keep an eye on in future quarters. And then, as you can see, we have the other 2 points. Now, I do want to point out 3 more things really briefly. Okay. One of them is the dividend. Okay, the dividend here. The company paid a dividend of 33 cents per share. They do talk about they haven't repurchased any shares this quarter. They are quite a leveraged company. There is significant leverage there. They are paying down their debt. And I want to circle back to where I started at the beginning about interest rates. They are also feeling the increase in the interest rate because their interest rate now, the weighted average interest rate that they're paying is increasing. So of course, whereas if I was here talking to you about this 3-4 years ago, The way in which you would have managed significant cash flow in a company then is borrow for practically nothing, buy back your shares. If you didn't have any investment opportunities or capex opportunities or mergers and acquisitions opportunities, buy back your shares, and then of course that would have an upward effect on your earnings per share. Whereas instead now the focus is, okay, how do we pay down the debt, because while interest rates may be higher for longer. The other thing I want to show you is that they added 180 million. Let me get this here. Yeah, they added 180 million. Okay, it's in the transcript. But they did add 180 million to their cash flow this quarter, which is very significant, and EBITDA, yeah, this one. And also, I just thought it was interesting. They're only adding 20 million to their capex, which 20 million to me seems a little small, but that's what it is so far. This is the last number, and then I'm handing it back to you, Rick, in about 15 seconds, and that is this. EBITDA is something that we really and truly pay a lot of attention to in the stock market, because EBITDA is your earnings before interest and tax, and it's also before depreciation and amortization. If you were on my Savvy Investors show last week, my Savvy Investors at VectorVest show, I ran an episode about how to read a P&L, how to read a profit and loss, and I explain exactly what EBITDA is. But what particularly D and A are non-cash expenses. Interest and tax, of course, only are paid. Interest and tax are not a function of the business. Interest is a function of how much money the company has borrowed, and tax is a function of the profit itself. So EBITDA is a very pure profitability figure that is that measures the operating business itself, but specifically the profitability of that business itself. And I was also struck by this as well. So adjusted EBITDA, which includes blah, 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 right? I'll leave that bit out. That increased 12.1% to 613 million in the quarter, primarily driven by the increase in gross profit. So you can see how these profitability metrics are coming up again and again, but the nuance underpinning them all is what is driving that reaction to the share price. On that note, Rick, thank you very much indeed for having me today. I'm going to stop sharing my screen now, and I am going to hand you back to him. But before I do, thank you very much indeed for the opportunity to present to you. It's always a joy. And I think that earnings reports are such an education. They're such a fascinating insight into the present and into the future. And also, of course, they're also an opportunity where the CEO gets to explain, the CEO, maybe the vice president of investor relations, possibly the CFO, could be a range of people within the business, get a chance to communicate directly with investors, and on top of that then answer the questions that analysts are putting to them. So they're brilliant. But I always start off picking my earnings reports from my search that I have in Unisearch and VectorVest, and then I compare what VectorVest is saying about the stock, so that then I can get an actionable insight into that stock then before getting into the nuance of it all and understanding what's going on. So everyone, thank you all very, very much. A huge thank you very much indeed for having me here today. Rick, back to you, and thanks again.
Thank you so much, Susan. Loved it. Excellent presentation. And it was just a coincidence, Susan, that you picked a food brands company. And one of the things that really sticks out to me these days is just how many brands are owned by the same company. Of course, we have that everywhere. And, I'm interested to ask you, so we have something that's emerged in Canada here where we actually have brands being pulled out of our market. So we have companies like Nestle who have decided they're not selling their products in Canada anymore. So we have things, I have a search going off on the side here, like Delicio, Stouffer's, Lean Cuisine, Life Cuisine. All of these have been pulled out of the Canadian market. We've had snack foods like Bugles. And a lot of times, if we have higher quality food products pulled out of our market, what we're left with are the store brands, the no-name brands, what a lot of people will consider lower quality, right? So I'm sure this is something we're seeing in all of our countries. It's not just something that's limited to Canada, but very interesting when we see companies make, conscious decisions to stop selling their products in certain markets. And we're not huge, but we're 40 million-ish, as we're told these days. What are your thoughts on that?
Rick, we see that a lot across the world, and I think it comes down to the fact, like if you look at Unilever, or if you look at Mars, of course, if you look, even take a look at Coca-Cola, take a look at PepsiCo, there's a range of companies, all right, that do have a plethora of brands, and sometimes people are surprised to hear that one brand is connected to another from that point of view. Like, for example, if you take a look at Coca-Cola, they own innocent smoothies, if I'm correct, when I looked at this last, and you might think, oh, that's total yin and yang, but if you're deciding to take a product out of a market, indeed, it can be down to distribution, it can be down to a business decision, and also, of course, it could be down to the fact that they are looking at a future product and brand proliferation there that is lining them up along the way. But you are right in the fact that we are in an environment where you've got grocery inflation being really, really it's not something that people are just talking about in the news. This is what people are talking about in the aisles. And therefore, that product mix about what's on our shelves and the choices that we make about what we buy and who we buy from and what we value now is changing, of course. And sorry, when I say it's changing, it's been changing, particularly for the past 18 months or 2 years nearly at this stage. So when it comes to making those strategic decisions, I think it's driven by macro factors. It can often be driven by business decisions that we don't know anything about. And then, of course, there's also the incentives and the A&P, the advertising and promotion that the company is deciding which brands to back and for how long.
Yeah, very interesting. And all of those, most of those that I mentioned, those were all owned by Nestle. So that was one company owning a large number of brands and deciding to pull them all out. So anyway, it looks like we're right up against time. So I'm going to advance our slide here. So, great thank yous out there to the excellent presentation by Steve and Susan as well. I want to make sure I thank Joey, who's handling things so professionally in the background. We've got Ray, who's been covering all of the comments for us. So thank you, everybody there. And most of all, thank you to all of you who have decided to make some time in the day and your weekend. And as mentioned, on the Canadian side, your long Thanksgiving weekend. So hopefully everybody has a good rest of your day, rest of your weekend, and we'll be looking forward to the next trading week. What I'd like to just say before we sign off here, so we at VectorVest are always looking for people who are interested in presenting in a forum such as this. So if you have an idea, and you'd like to put something together and present in this forum, if you could reach out to Ray Clark. So we have his email address right at the bottom of the screen here, rayc@vectorvest.com, and send him those ideas. We'd be more than happy to have some of you folks, as we do with, Bob Turnbull, Mike Simonato, come in, and I think Les Masonson as well, come in and present in this forum. All right. So with all that said, thanks again for watching, and have a good rest of your day and good rest of your weekend. Here you have all of our support numbers on the screen as well. And keep in mind, folks, that the replay is available on YouTube, and the slides will be sent out an email on Monday. So thanks again to everybody. Take care.